Hey, what's going on, guys? Welcome back to the channel. If you're new here, my name's Hunter and I make videos about investing and trading in the stock market. So today's video is going to be about 3 things that I wish I knew before I started investing. I think when people first start investing, they tend to overlook all of the downsides, right? Nobody wants to hear about the risk involved or what you should be doing if a position goes against you. And I was in the same boat. The last thing I wanted to hear about was risk management or anything like that. I just wanted to jump right in, fund an account, and then just start trading right away. But obviously, this is not the way to go about it. And I've said it before, but if you want to be successful in the stock market, where so many people end up losing money right away, you're going to need some form of a different approach. So hopefully you guys can relate to this video. And if there's anything else that you think people should hear, or maybe you just have some tips and some things that you wish you knew before you started, leave a comment down below so that everyone can kind of just go through them and see what everybody else has to say. So if you haven't already, hit that subscribe button and let's get right into it. So the first thing I want to hit on is position sizing, or how much money you should have in a single stock. I think a pretty common theme, or really just a popular style of trading these days, is swing trading, where people will buy a stock and then hold it for a few days or maybe even a few weeks before they sell it. And even though this way of trading is definitely a lot less risky than just flat out day trading, the problem with this is that I see a lot of people when they first get started dumping nearly half of their portfolio into single positions. So let's say somebody had $5,000 in their account and they wanted to be a little more active. They didn't want to hold 10 or 15 positions for the long term, so they decided to just focus on a couple and then buy them, hold them for a few days, and then try to flip them for a quick profit. And there's nothing wrong with trying to focus on a few stocks, as it can definitely be tough to follow, say, 10 or 15 at a time, but you definitely should not be throwing all of your money into just a few positions like this. Because at this point, what happens if those stocks go against you for a few days or maybe even a week? If you don't have anything else to balance it out and all of your money is allocated to just a few positions, then you can go in the hole pretty quickly. And if you don't have anything balancing that out, it can be definitely pretty tough to try to get out of. And I am totally speaking from personal experience here. I'm not trying to rip on anyone or try to bash anybody's trading style, but this mindset is what absolutely crushed me when I first got started. So I'll try to give you guys at least some form of an outline, just so you can have a better idea of how much money you should be putting into single stocks based on your account balance. So a general rule that I like to follow is to have a max position at 10%, or 10% of your account balance. So say you had $10,000 in your account, your max position would be around $1,000. And this 10% position is something that you can work up to. Just because you like a stock or an ETF doesn't mean you have to go all in at once and buy that $1,000 on your first go. The beauty of zero commission trading is that you can buy a stock either multiple times throughout the same day or even over a couple days to help build up your position. So for example, say that the market's about to open and you have a few stocks on watch that you're looking to buy. Instead of just going all in on those 5 when it opens and trying to predict the bottom or trying to look for a reversal, you could buy, say, $300 worth at first, and then if it drops a little bit, you could buy another $100 or $50. And then throughout the day, if it goes up or down, you could just continue buying in small increments, say $50 or whatever, $75 at a time. So that way you're buying throughout the day and you're not just taking one shot at it. Then this helps just average out your price so you don't get caught, say, if you buy the stock and then it ends up selling off right away. At least at this point, you can add to it on the way down and add to it on the way up to help average it all out. And that's kind of just a rough outline. It might be tough to figure out how much money you want to use initially when you first enter the position, and then how much you want to add to it throughout the day. But if you continue to do it this way, you'll pretty quickly figure out what amount you'll be comfortable using and really just how much you want to add to it or how many times you want to touch it throughout the day. But this is definitely a better way to do it than just taking one shot at it and hoping it goes up right after you buy it. And this will also change depending on what type of stock you're investing in. Say you have a big blue chip stock like Apple or Microsoft or an index fund, you're going to want to allocate more money to positions like that than you would over a small cap stock with a much higher beta. And if you don't know what beta is, this just measures the volatility of a stock compared to the overall market. So if you see a stock have a beta that is greater than or really much greater than 1, That tells you that it'll have more aggressive price swings on a daily basis than the overall market. So say the S&P 500 moves 1%. If you have a stock with a much higher beta, that means that it will tend to move a lot more than that 1% or just really have more aggressive price movements on a daily basis. And this is what's referred to as beta adjusting your positions, which is really just what I mentioned. It'd be putting more money into stocks with a lower beta and then less money into stocks with a higher beta. So you probably wouldn't want to have a 10% max position in a stock with a high beta just due to those more aggressive price swings. All right, and the next one is something that I'm sure you've heard before, but it is that the trend is your friend, and I know that there's a lot of definitions for that out there, so I'll go ahead and give you mine. A lot of the time I hear people say that the trend is your friend when they're referring to day trading, or that you should really only focus on stocks with a strong uptrend on the day. But I like to look at the bigger picture and look more towards the 3 to 6 month direction of the stock. And when you focus more on the 3 to 6 month time horizon, I think that you can really just zoom out, look at the bigger picture, and truly see if the trend is in your favor. And I don't know if this is just me, but I used to always just focus on recovery stocks or stocks that I thought were cheap, that were trading near 52-week lows or something like that. Then I was hoping that something out of the blue would happen and then I'd have this huge margin for profit. But if a stock is trading in a bearish trend and just continuing to make lower lows over a 3 to 6 month period, there's definitely a reason for that. But just because a stock might seem cheap or you think that there's a lot of upside potential doesn't mean that a recovery is going to happen, and that really just shows zero indication that anything is going to start to reverse. And one of the reasons why I would do this and always look for just cheaper stocks is because I was always hesitant to buy stocks when they're at all-time highs. But what I realized is that stocks at all-time highs tend to continue to make all-time highs, and it is much better to focus on stocks within a strong bullish trend and look for buying opportunities when they're pulling back. So if you have a stock that you like from a fundamental standpoint that continues to make higher highs and higher lows, it makes much more sense to focus on a stock like that than one you might like that continues to either make lower lows or just hover around the same low point. And this also ties in with the idea that every stock you buy doesn't have to be a home run, right? You don't have to look for 50, 60, 70% upside in stocks, because if we're being honest, that just rarely happens. So I would much rather focus on stocks that are in a nice bullish trend. And then if they have pullbacks, look for maybe 3, 4, 5% gains, and then just continue trading around those. And if you don't want to be such an active trader, then another tip I would have that kind of goes along with all this is to just not be afraid to let your winners run. And what I mean by that is that if you have a stock at all-time highs, don't feel like you have to sell all of it just because it had a nice little run up. If you want to sell some of the position and then maybe add to it when it has a little correction, that's totally fine, but just don't feel like you have to try to time it perfectly and try to time every single top. And that takes us to the last point, which is to just avoid penny stocks at all times. Probably heard this over and over again, but people still just continue to block out all the noise and go on a hunt for what they think is going to be the next best penny stock. There are so many of these on the market, and everyone thinks that they're going to be able to see something that nobody else does, but in all honesty, it is just a complete waste of time. There's absolutely zero process that goes into buying penny stocks, and whoever's out there telling you, or you might see people online saying how the next penny stock is going to explode for whatever reason, they're just completely lying, and that's because they own it, so they're just trying to pump it up to as many people as they can. So it's much better to focus your time and energy on good, well-known companies than it is to just go out and start dumpster diving for the next best 35-cent stock. And I think one of the reasons that people kind of just move towards penny stocks as soon as they get started is because they might think to themselves, well, if I only have a couple $100, would it make more sense to just go out and look for cheaper stocks, because then I'd be able to buy more shares? But they're kind of just missing the point on that, as it's not about how many shares you have, it's about how much you put into the stock and then the percentage change from there. So if you put $200 into a penny stock, just because you have more shares of that stock doesn't mean you're going to be making any more money than if you put $200 into, say, a Facebook that has the same percentage change. And with just a few $100s, you can invest in some very good companies. And at least this way, you'll be actually playing the game the right way and then kind of just building yourself a process building yourself some investment strategy that your future self will thank you for. You don't learn anything about the actual market when you're investing in these penny stocks. You truly are just gambling. So, I mean, if you want to do that, go ahead, but that's probably not the best way to go about it, and that is something that I definitely wish I could take back. So hopefully you guys got something out of that video. If I had listened to all those points when I first got started, it would have just saved me so much wasted time, energy, and a pretty good amount of money. So if you're still here, make sure to like and subscribe, and I will see you guys next time. Peace.